Usually when we talk about how financial markets react to news, there is this comforting expectation of simple cause and effect.
Right, like gravity.
Exactly, like gravity. A company reports that they made less money than expected, they missed their earnings targets, and the stock drops.
Yeah, it's binary. It's totally predictable. Bad news equals red numbers on the screen.
But then you step into the world of tech turnarounds,
Mm.
and suddenly gravity it just stops working entirely.
It really does.
We are looking at a financial landscape today that is completely upside down, which honestly makes it incredibly compelling. So welcome to our in-depth exploration for the day. Our mission, we are unpacking a real-time, frankly mind-bending anomaly in the tech sector.
It's a fascinating one, too.
It is. We're looking at Cognizant. They are an absolute giant in IT services, and they just reported their second quarter numbers for 2026. And guess what? They missed their earnings expectations.
Right, a classic bad quarter, at least on the surface.
Yet instead of the stock plummeting like you would expect, it violently rocketed upward.
Yeah, we are talking about a surge of over 11% in a single day. It entirely defied that Wall Street gravity.
11% on a miss. Which brings us to the central question of this analysis, for everyone listening. Is this massive price jump just a speculative fluke, like some weird glitch in the market matrix? Or is the market finally waking up to a deeply undervalued company that is actually right in the middle of a massive AI transformation?
To really understand this anomaly, you have to look past those surface-level, flashy headlines. I mean, the top-line news completely misses the actual story here.
It usually does, right?
Exactly. You have to examine things like cluster buying by insiders.
The people who actually know the company's internal health best.
Right. And you also have to look at a hidden AI moat that their traditional tech peers just cannot easily replicate.
Okay, let's unpack this. Because before we can understand the market's explosive reaction to the stock, we really need to lift the hood and look at the actual Q2 2026 financial engine. Like, why on earth did the market just completely forgive and ignore an earnings miss? Let's start with the money actually coming in the door. How did the top-line revenue look?
Well, the underlying engine is actually humming along beautifully. Revenue for the second quarter of 2026 grew by 8.1% year over year.
Oh, wow.
Yeah, they brought in $5.48 billion. So the actual volume of business, the money flowing into the company, is growing very solidly.
Okay, that paints a very different picture from a company in decline.
Yeah.
But the earnings per share, the EPS, that's the metric that gets all the attention. And that's where the miss actually happened. So how big was the miss? And more importantly, why did it happen?
So they came in at $1.37 per share, which narrowly missed the Wall Street consensus of $1.40.
A 3-cent miss.
Exactly. But here's the critical why behind that miss. It was not because they lost clients. It wasn't because they had to slash their prices to stay competitive. That miss was driven almost entirely by integration costs from their recent acquisition of a company called Estrella.
I love looking at acquisitions this way because it makes so much sense when you frame it right. Think about it like a kitchen renovation.
Or kitchen renovation.
Yeah. You look at your bank account right after paying the contractor, and it looks terrible. Your short-term cash flow is just taking a massive hit.
Right.
That is the equivalent of this earnings miss. But you didn't just burn that money. You upgraded the house. You spent cash to permanently increase the baseline value of the property.
That is a perfect analogy, and the market clearly saw through those temporary renovation costs because that Estrella acquisition is projected to add 150 basis points of revenue growth going forward.
Now, for the everyday investor listening, when we say 150 basis points, we are basically talking about an extra 1.5% in pure revenue growth.
Precisely. I mean, 1 basis point is just 0.01%. It sounds like small math.
Yeah, it sounds tiny.
It does, but when you are dealing with billions of dollars in revenue, an extra 1.5% is a massive influx of cash. And the market also saw strength where it truly matters. Their financial services segment, which is a massive, highly critical sector for IT, grew 12%.
12%, that's huge.
It is. Plus, their full-year adjusted operating margins are remaining completely intact. They're projected right around that 15.5 to 15.7% range.
So the business itself isn't deteriorating at all. It's just paying out of pocket for future growth.
What's fascinating here is the sheer financial defense this company has built. They have what you would call a fortress-like balance sheet.
Afford.
Yeah, because they have so much cash and stability, they are executing a massive capital return program. They are returning roughly $2 billion to shareholders in 2025 and another $1.6 billion in fiscal year 2026.
Wait, hold on. Let me push back on this for a second.
Sure.
If this company is supposedly in the middle of this.
Exactly. Even if the company's total market value stays the exact same, by shrinking the pie, your individual slice of that pie just got bigger and more valuable.
That makes a lot of sense, and it definitely explains why the market didn't panic over a tiny 3-cent earnings miss.
Yep.
But you cannot survive in the tech sector just by playing financial defense and, shrinking the pie. If the underlying financials are stable, where's the explosive future growth actually coming from?
For that, you have to look at the bookings momentum.
Oh, bookings.
Right. Bookings are essentially contracts signed today for work that will be completed and paid for in the future. It is the ultimate forward-looking indicator for an IT services company. And their trailing 12-month bookings grew from $27.8 billion in the second quarter of 2025
Okay.
to $29.6 billion by the first quarter of 2026.
Wow. So they are sitting on almost $30 billion in the pipeline.
They are.
That is an enormous backlog of guaranteed work.
It is. And they are maintaining a strong 1.4 book-to-bill ratio.
Let's translate that for our listeners. Book-to-bill is basically measuring what you are selling versus what you are earning today, correct?
Exactly. A 1.4 ratio means that for every single dollar of revenue they bill and collect right now, they are simultaneously signing a contract for $1.40 in new future business.
So the pipeline is filling up 40% faster than it's draining.
Precisely. And crucially, this includes multiple mega deals. We are talking about individual contracts worth over $1 billion each.
$1 billion each.
Yeah. And these mega deals are moving from the early transition phase into the actual production phase in late 2026. That is when the heavy lifting starts and the real revenue starts hitting the income statement.
And we cannot gloss over the aerospace and defense sector here, because the data shows they secured a contract through their Belkin unit with a ceiling value of a staggering $150 billion.
It's massive.
It is. But why is defense such a big deal for an IT company?
Because it creates a massive structural advantage. That level of defense contracting locks out standard IT competitors entirely.
How so?
Well, an everyday tech company simply doesn't have the required security clearances, the regulatory framework, or the specific domain expertise to even bid on that kind of aerospace work.
Yep.
It creates a highly captive, almost unshakable revenue stream.
That makes sense.
But as impressive as that is, the biggest structural advantage, the real moat we need to talk about, is their AI platform stack. They reported over 5,000 active AI engagements, and nearly 40% of their internal code is now AI-assisted.
Okay, hold on. I have to play the skeptic again here.
All right.
Because right now, literally every single company on Earth is slapping the label AI on their business. I mean, my refrigerator probably has an AI sticker on it.
It's everywhere.
Everyone claims they are revolutionizing their industry with artificial intelligence. So what makes this an actual defensible moat and not just, another corporate buzzword designed to appease Wall Street algorithms?
That is the most important question to ask right now. To understand why this is a real moat, you have to understand the concept of switching costs combined with deep vertical domain expertise.
Okay, break that down for me.
Well, Cognizant isn't just using AI to write generic marketing emails or summarize meetings. They have formed deep structural partnerships with Anthropic, Google Gemini, and OpenAI. And specifically, they are using Anthropic's Claude to modernize legacy bank code.
Legacy bank code. So we are talking about the ancient foundational infrastructure that the entire global financial system runs on.
Yes. We are talking about code written 30, sometimes 40 years ago.
There you go.
It is incredibly complex, heavily patched over decades, highly regulated, and absolutely mission critical. If it fails, global finance basically grinds to a halt.
Right.
You cannot just ask a generic public chatbot to rewrite a global bank's transaction ledger. It requires a highly specialized, intensely secure operational capability to deploy AI within those lockdown environments. Classical IT peers simply cannot replicate that overnight.
That makes a lot of sense. It's not just a plug-in.
Exactly. And to push it further, Cognizant just launched a dedicated EME AI unit covering Europe, the Middle East, and Africa specifically for deploying what they call agentic AI at scale.
Agentic AI, meaning AI that doesn't just answer questions, but actually takes independent actions to solve problems.
Exactly. They are building an operational moat where their AI systems understand the specific intricacies of banking, healthcare, and defense.
Yeah.
That is not a marketing moat. That is a fundamental shift in how the work actually gets done.
Okay, so let's summarize where we are. We've established a highly profitable business, a fortress balance sheet buying back billions in stock, a massive $30 billion backlog of future revenue, and a legitimate, deeply integrated AI pipeline modernizing legacy finance.
Right.
So, why was this stock trading like it was going out of business just a few weeks ago? And what caused that sudden violent snapback up to $56.08?
The short answer is that the broader market just got overly pessimistic to an almost historic degree. Through the first half of 2026, the stock was caught in a brutal downtrend.
Just bleeding out.
Yeah. By early summer, it was down nearly 40% for the year, dropping from a high of over $87 all the way down to $37.08.
A 40% haircut for a company that is actively growing its revenue and buying back its own stock. That'd feel like a massive disconnect.
It was. The stock suffered extreme valuation compression. It reached a multi-year low price-to-earnings ratio, or PE, of 10.78.
And for anyone listening who doesn't look at PE ratios all day, that basically measures how much you are paying for every dollar of the company's profit. A PE of under 11 for a highly profitable tech leader operating in the AI space is virtually unheard of in today's market.
It's incredibly rare. It also hit a price-to-sales ratio of 1.12. The market was essentially pricing in zero future growth and assuming significant deterioration of the business.
Wow.
The sentiment was completely detached from the fundamentals.
And then we get to the July 29th reversal. The earnings drop. The pre-market headlines are totally bearish, highlighting that 3-cent EPS miss we talked about. The shares are actually down 2 to 3% before the market even officially opens.
The initial panic.
But then the opening bell rings. It opens at $50.17, and it just relentlessly climbs, finally closing at $56.08. The data describes this as a bullish Marubozu-type candle. That is some heavy technical jargon. What does that actually look like on a chart?
A Marubozu candle is basically a visual representation of total dominance. In plain English, it means the stock opened at its absolute lowest price of the day, buyers immediately stepped in, and the price just went straight up without ever looking back.
No dips at all.
None. It closes at its absolute highest price of the day. There were no sellers capable of pushing the price down. It indicates total unshakable buyer control. It is the absolute definition of a trend change.
Here's where it gets really interesting, though. Because while the mainstream news headlines were framing the earnings miss as a disaster, the data shows something completely different going on behind the scenes with the people who actually run the company.
The insiders.
Yes. Over the trailing 90 days leading up to this, there was net insider buying of over 34,500 shares. We are talking about 80 individual buy transactions from insiders versus only 74 sells.
If we connect this to the bigger picture, you are seeing a textbook example of the sell the news, buy the dip phenomenon, but functioning almost in reverse.
How so?
Well, bad news, the earnings miss, was already priced in by the market. When a stock has been punished for 6 months and is trading at a deeply depressed PE of under 11, the market has already assumed the absolute worst-case scenario.
So they can't get any more pessimistic.
Exactly. So when the news is only slightly bad, or in this case actually masking really strong underlying growth, the sellers are exhausted and the buyers rush aggressively back in.
The data also flagged a potential short squeeze setup here. Can you walk us through the mechanics of how that acts like rocket fuel for a stock price?
While it's unconfirmed at this stage, the profile is definitely there. Imagine institutional investors, large hedge funds, who have been aggressively short-selling the stock for 6 months. They are betting that the price will keep falling.
Right.
When they short a stock, they borrow shares and sell them, hoping to buy them back cheaper later.
But then the stock suddenly jumps 11% in one day.
Exactly. Suddenly, those short sellers are losing massive amounts of money. To stop the bleeding, they are forced to buy shares on the open market just to cover their losing positions.
Oh, wow.
So you have the regular investors buying because the stock is cheap, the insiders buying because they know the company is strong, and the short sellers desperately buying just to get out. All that forced buying pressure compounds on itself, driving the price even higher.
So what does this all mean for the everyday investor listening right now? Because no analysis is complete without looking at the dark clouds on the horizon. Let's look at the bear case.
Always a good idea.
Management themselves forecast that Q3 revenue would be between $5.60 and $5.68 billion. Now, that is visibly lighter than the $5.70 billion that Wall Street wanted to see.
It is.
And they specifically cited cautious discretionary IT spending by clients. If major global corporations are afraid to spend money on IT right now, isn't this a highly dangerous time to jump into this story?
Macroeconomic weakness is absolutely a real, tangible risk. Discretionary IT spending basically means the nice-to-have projects. Upgrading an absolute critical security system is mandatory, but experimenting with a new digital customer portal, that's discretionary.
Right, it's the first thing to get cut.
Exactly. If the global economy tightens, clients delay those big experimental IT projects. Furthermore, those integration costs from the Astrea acquisition could easily continue to pressure their profit margins in the near term if management drops the ball and doesn't execute perfectly.
So there are real risks here.
But this is exactly where the concept of a margin of safety comes into play.
Because the stock has already been beaten down so much.
Precisely. The stock has already been punished for all of those fears. It is already trading at a steep discount. Because the valuation is so compressed right now, it creates a floor. And it means any surprise improvement in that discretionary spending acts as a massive upward tailwind.
And there are catalysts coming up, right?
Yes. Look at the catalyst calendar ahead of us. We have the Q3 earnings coming up, which will be the first full quarter actually showing the results of the Astrea integration. We have that August and September window where those massive billion-dollar mega deals finally begin their production phase revenue recognition.
Meaning all that backlog finally starts turning into actual cash on the balance sheet.
Yes. And finally, you have the potential macroeconomic tailwinds, like the very real possibility of Federal Reserve rate cuts in the second half of 2026.
Right, because when interest rates drop, borrowing becomes cheaper.
Exactly.
Yeah.
That naturally spurs corporate spending, which directly benefits IT services. The downside seems heavily priced in, while the upside catalysts are numerous and lining up perfectly.
So, bringing all these complex threads together, what is the final verdict on this turnaround story? Based on the analysis of all these factors, this investment thesis receives a bullish score of 7.5 out of 10.
A solid score.
It is, but it is very specifically framed, not as a quick flip or a day trade. This is viewed as a multi-quarter hold. We are talking about a 6 to 12-month horizon.
It is fundamentally a mean reversion opportunity.
Let's define mean reversion for the audience before we close out.
Simply put, mean reversion is the financial theory that extreme highs and extreme lows are temporary, and prices will eventually revert back to their long-term historical average. You have an oversold AI-era IT leader. They have massive bookings, a huge defense contract, and a $2 billion capital return program that effectively acts as a safety net under the stock price. You are simply holding and waiting for the broader market to wake up and realize the value that is already sitting there, especially as those mega deals accrete to the bottom line.
This raises an important question for you, the listener, to take away and think about regarding your own strategy. Are you looking at your own portfolios and accidentally ignoring structurally sound, cash-generating companies simply because the broader market sentiment or the latest financial headline is temporarily negative?
It's easy to do.
It really is. Sometimes the biggest opportunities are hiding right behind a seemingly bad earnings miss.
It requires discipline. It requires separating the underlying business performance, the actual math, from the emotional reactions of the stock market.
Absolutely. And I want to leave you with one final, slightly provocative thought to chew on that builds on everything we've discussed today. We talked about how Cognizant already has 40% of its internal code assisted by AI.
Right.
Well, what happens to the traditional IT services business model if this trend accelerates? For decades, these consulting and IT giants made their billions by billing for thousands and thousands of human hours. There's a sheer volume game.
Very true.
If AI eventually does the bulk of that coding and implementation work in seconds rather than months, does that destroy their legacy revenue model entirely? Or, because they own the specialized AI deployment platforms, does it make their profit margins absolutely astronomical?
That is the million-dollar question.
The company that figures out that balance first isn't just going to bounce back. They are going to redefine the entire tech sector. Thank you for joining us on this analysis. Stay curious, keep looking past the headlines, and we'll catch you on the next one.